Thank you, Arturo Porsekensky with American University. Ever since Northern Rock, we've known that Basel I and Basel II had a big black hole, which is the management of liquidity risk. Namely, such obsession with the asset side and no mention of the liquidity risk, such that a bank, whether it relies for its funding on a stable retail deposit base or on unstable interbank borrowing, it gets treated the same. This was confirmed with Bear Stearns' fall, of course, which was also a liquidity risk. Now, all this year, as I understand it, the Basel Committee folks have been very busy trying to plug that hole, addressing liquidity side risks. They came out with some draft regulations, and then last month came out with a final paper on recommendations how to address liquidity risk. Since it doesn't seem to have made it to your book or to your presentation, do you have a view on the management of liquidity risks?
Sure, and Arturo, actually, it made it in here only as an example of something important that was pushed aside unwisely because of the focus on credit risk. Here are my views in short on liquidity risk. First off, I thought it before, I think it even more now. There need to be more attention paid to liquidity risk for all the reasons that you said. That's number one. Number two, even with the renewed attention to it, in the most recent efforts of the Financial Stability Forum and the Basel Committee, it seems to me that there is a big question that is looming out there. And that is, are principles, guidelines for liquidity risk management sufficient? Or should there be numerical requirements, numerical tests for liquidity that are not comparable to, but of the same ilk as some of our numerical tests for capital requirements? Traditionally, the answer supervisors have given to that question has been no, because it's too hard to do it. It's going to be too blunt. Institutions are too different and the like. Without suggesting how I think things should ultimately come out, it does seem to me that there needs to be more serious attention paid to the possible forms of a quantitative liquidity requirement. The financial supervisory, is it FSA, the UK FSA, I can never remember, supervision or supervisory, but the FSA, the Financial Supervision Authority in the UK, had a paper earlier this year in which they assessed the different kinds of approaches to liquidity management and liquidity regulation. They reviewed the theoretical work that's been done on the potential for a quantitative indicator. Again, this was by researchers, and of course they don't want to, just like our Fed economists don't try to make policy recommendations in their papers, the FSA guys didn't want to either. But you couldn't help but read that paper without thinking, they think that there needs to be more attention paid to this. And if my instinct on capital, that for all their shortcomings, simple rules have a lot of merit in dealing with complex systems, is correct, seems to me that's not a bad starting point for thinking about liquidity management as well.
Andre
Larian on Cato Institute. First of all, thank you very much for this terrific presentation, and thank you, Fred, for encouraging you to doing this work. I have two questions. The first one is really very simple one. I'm really curious whether you ever had this or similar presentation to the Basel Committee itself. And second, you looks like skipped these alternative slides. You have a chapter in your book, but if you can spare a couple of minutes describing what kind of alternative you have in your mind.
Okay, sure, thanks. Okay, so on the first question, I will say two things. First, I think I talked to about 50, somewhere around 50 present or former supervisors in the course of doing this book. What I decided early on was that I shouldn't quote any of them, and I wasn't even going to list them in the acknowledgments, because some of them said to me, I really would like to talk to you. I really don't want anybody to know that I talked to you. And I thought that rather than sort of identify the people who talked to me and said, yeah, sure, I don't care, what do I care? And then leave out others, I would just not identify anybody. So I haven't identified them. The second thing I'd say about that first question, though, is in the summer of 2007, I taught in the economics department at the University of Basel. Okay. Now, the second question that you asked was about alternatives. Okay. And the short answer here is I don't think there's any ready-made alternative out there. I don't think there's I don't think there's an optimal, well-understood mode of regulating capital. We are dealing in a world of third best, fourth best maybe, perhaps based in part on the inherent difficulty of the exercise, perhaps based upon inadequate attention to or focus upon some alternatives. What I do in that chapter is first ask, does it make more sense just to keep a standardized approach corrected for some of its more egregious shortcomings? And the answer I give is essentially, maybe, but I'm not prepared to say that's optimal. You can tell from what I did in my recommendations that where the maybe part is, if a country says this is what we're going to do, we're going to take a standardized approach as well as requiring big banks to have sophisticated credit risk models that are validated, maybe that's okay for the time being. But the criticisms of the standardized approach or of Basel I have real force. It's not as if somehow just because Basel II is so misguided that Basel I has all of a sudden become better. It still has the shortcomings that it has. I also investigated in there both the so-called pre-commitment approach and the subordinated debt approach. Pre-commitment approach basically says let the banks do it, but with a twist. So you let a bank say how much capital they're going to set aside, and they have to identify what their expected losses will be. If at the end of each reporting period the losses exceed the capital that they set aside, they'll be penalized. And thus that's supposed to serve as an incentive for them to get it better the next time. That notion was developed in the concept of market risk models about 15 years ago. It has been periodically brought to the fore again. Charles Taylor did it most recently in the context of both market and credit risk modeling. The big problem there are two big problems with it. First, you have to decide what the penalty is going to be. And that turns out not to be an easy thing to do, because the penalty has to be enough to get people doing it right, and but also not so big as to be debilitating if a bank doesn't get something right. The second problem is, because this is sort of an ex post exercise, a bank that's in extremis might say, hey, the penalty's coming 3 months from now. We're in trouble now. Let's run down our capital. Okay, so it's the theoretical problems with pre-commitment are non-trivial. That's why I think the Fed kind of shoved it aside 10 years ago as a potential option. I suggest that it's worth revisiting to see if some variant on it may be useful. Sub-debt's been done by not by everybody, by a lot of people. You wouldn't believe how many citations there are in the literature on subordinated debt. The basic idea in sub-debt is, hey, let the market decide, make every bank issue subordinated debt of a certain type that's standardized, watch the fluctuations in the traded value of the subordinated debt. If ABC Bank's subordinated debt is down in value relative to everybody else, you'll know there's a problem, and some sort of supervisory consequence will ensue. In its more quixotic forms, people will say, just let the banks set their own capital, and if the market doesn't like it, the price of the sub-debt will go down, and the banks will adjust. Okay. That seems to me an enormous leap. But those are the alternatives that are out there. As you can tell, none of them is really ready for prime time, even though pieces of them might be useful.
Mike?
Mike is next.
Yeah, Dan, I appreciated the book, which I would characterize as, I think, it was not a straw man you set up as your brief characterization of Basel II. It is really the essence of Basel II. However, my concerns with Basel II, and therefore with the subject of your book, also relate to Basel I, and were things that I expressed not to the Basel Committee, but to the same people in their alter ego as the G10 deputies. And it seems to me that there are three fundamental problems with this entire area of thinking and regulation. First fundamental problem, which you alluded to but didn't, I think, develop enough, the magnitude of risks undertaken by banks and other financial institutions is, in fact, enormous. Major banks in the United States, on a mark-to-market basis, were insolvent in 1975. They were insolvent again in 1981-82. And they were insolvent a third time in 1991. We weren't doing mark-to-market. We were lying about what the true state of affairs was. But if we had marked their assets to market, they would have been underwater, as ultimately the savings and loans were revealed to be. Probably on this occasion, were it not for the truly massive intervention by the government and the Federal Reserve, we would have a situation where much of our financial system would now be insolvent on a current accounting basis, that is, marking to market. So, in fact, the risks which the banking system are undertaking are very, very big. Something which drives them into insolvency on average once a decade is a big risk, and their capital is simply woefully inadequate to deal with that level of macroeconomic risk. And we need to make up our mind whether we want the taxpayer, in effect, to stand in holding the bag in those circumstances the way it's happening now. I'd say that's first order consideration. Basel I, Basel II, neither of them fix that problem. The level of capital that we're talking about, a little bit more, a little bit less, doesn't do it. You need something triple, quadruple the amount of capital in the banking system. Second problem, which you don't refer to, is we don't have in Basel II or Basel I capital standards. We have capital ratio standards. And you can meet the standard by adjusting either the numerator, capital, or the denominator, assets, risk-weighted or not. For an individual bank, it may not make much difference. They're taking on too much risk, they've got too little capital. They can either cut back their assets or they can raise their capital. Fair enough. However, when it's the vast majority of banks in a circumstance like the present, it makes a hell of a lot of difference whether the desired capital ratios are achieved by raising the numerator or by cutting back massively on the denominator. That is a very serious problem. And it has not only to do with how you risk weight different assets and liabilities, even without that level of sophistication. In circumstances like the present, the tendency is for the banking system on its own, regardless of what the standards are, to want to have lower levels of leverage and to achieve that not by raising their capital, but by cutting their assets with disastrous effects for the rest of the economy. One needs to have a standard that can be enforced by compelling institutions in those circumstances to raise the numerator and not cut the denominator. That's not easy to do because it's something banks and other financial institutions really don't want to do. Dilute their existing equity owners at a time when their stock prices are already in the toilet. But we need to have a mechanism to do precisely that. And our bank regulators, rather than being the toadies of the banks, need to have sufficient guts to recognize that problem. Third key conceptual problem is bank capital. Bank capital is risk-taking, but it is not resource using. General Electric is a very large financial institution. The capital that backs General Electric's indebtedness is the entire capital of the corporation. All of the physical capital that they use to manufacture MRIs, jet engines, steam turbines, what have you, the value of all of that is still being used in the production of all of those products. But it is at risk to support, take care of any losses which General Electric capital might endure if the capital specifically allocated to that enterprise does not cover it. So in raising the level of bank capital, requiring banks to hold much more capital to absorb risk, we are not taking capital out of resource use. We're simply requiring the risk-taking element associated with that capital to be dedicated to absorbing any losses or capturing part of the gains from bank operations. Hence, we could operate a banking system with 20% or 25% capital. We did that in this country before the Depression. We could do it again.
All right. So I think actually, although those are analytically both very cogent points and discrete, I think they're related to the same set or issue. And let me explain why. The too little capital account, which, as you all can tell, I certainly agree with Mike. Maybe not order of magnitude, but I certainly agree with Mike's assessment of too little capital account, is related to a very important but almost completely buried assumption of the Basel Committee, which presumably carries into national regulation. What is the capital buffer, pardon me, what is the capital buffer supposed to do? Is the capital buffer supposed to achieve in a resolution mode the repayment of all debts above a certain level of seniority by the bank? That's one possibility. Another possibility is that the capital buffer is supposed to be sufficient to keep the bank as an operating, functioning, workably liquid institution. To do that, you're going to have more capital, just to be clear. A third possibility is that the capital buffer is designed not only to keep the bank afloat even in reasonably difficult times as an operating institution, but also, and this gets to Mike's point, also to make sure that even in those times, the bank will have adequate resources to continue to do at least some new lending. Now, when I say the issue has been buried, one of the things about this exercise was nobody ever said why we were taking and making the kinds of capital requirements that we were making. It was just accepted to be a next stage technical exercise following on Basel I. So there's some verbiage out there about, safety and soundness and competitive equality, kind of the boilerplate stuff you say when you're doing this. But there was no section which said, here's what we're trying to do with capital requirements. So I looked to see whether the men and women who did Basel II had, or were at least associated with it, had talked about these issues elsewhere. And I did find, for example, that former Chairman Greenspan had given a speech back in 1998, just about the time Basel II was launched, in which he said capital requirements shouldn't cover systemic risk. Shouldn't account for systemic risk. That's the responsibility of the central banks in their lender of last resort function. Okay? Now, I don't think that's the right way to look at things. for two reasons. First, the obvious one that's probably occurred to everyone, systemic risk is a bit of a problem, and maybe we should take account of it. But secondly, even at a very technical analytic level, if you've got capital requirements that are saying, let's basically just act like a private extender of debt, a private lender. What kind of capital do we require in the borrowing institution so that we can be assured of the repayment of our debt with whatever its seniority is? Chairman Greenspan suggested that's the right way to look at it. But that overlooks the fact that in the actual world, when people are extending debt to banks, they are asking themselves, will that bank fail? Or will the government step in, and help the bank stay afloat? So though you can't really mimic market-type decisions, because the market is in turn basing its judgments in part on what they think you, the government, are going to do. So from that somewhat technical analytic point, I think we grow out to this larger question of what the heck are we trying to achieve with these capital requirements, and why? And I would just, while validating the legitimacy of every point Mike raised, I'm not going to try to give my full answer to that other than to say, talking about what we're trying to do with capital and why is essential for having a sensible set of capital requirements. Do we want banks to have more or less capital than they do now, and why? That question was actually answered in the Basel I context. It was studiously avoided in the Basel II context.
We're close to our witching hour. I've got a lot of hands, but I want to get three people. I'm going to ask them to ask their questions sequentially, and then Dan to answer them together. Hopefully everybody's succinct. Gary, Joe Marie, and Bill.
Gary Horlick, Wilmer Hale, I want to let you expand on what you were thinking about at the end, but particularly there were very different experiences among the different Basel countries. So are there any lessons to be drawn from the different approaches Basel II countries took?
Okay.
Pass it over.
Joe Marie.
Thank you. Joe Marie Griesgraber with New Rules for Global Finance. I have a very simple question, Dan, and that is it ever reasonable or rational from the regulator point of view to have items off balance sheet?
Pass it back to Bill. Scanning. Bill, I'm sorry. Bill Niskin, I meant. Sorry. Got to give our guests privacy.
Bill Niskanen, Cato Institute. What is the most important lesson in the past 20 years that bears upon the relative desirability of international financial regulation as distinct from competitive national financial regulation?
Okay. Great. Well, it's going to be hard to give one answer to those three questions, so let me try to do them. In turn. Gary, it absolutely is the case that there were in our different experiences, and in some ways it gets to Bill's question. I mean, I didn't elaborate on this, but one of the reasons I have some measure of skepticism about the mega harmonization approach is because it necessarily starts to just run roughshod over important differences in national regulatory contexts and becomes a bit on the cookie cutter side, which can be quite inappropriate. I mean, ask a bank regulator in a developing country what kind of heartache Basel II is giving to him or her, and they will tell you. There are surely differences of experiences with the G10 as well, because we have different industry structures. The Swiss or German banking systems are structured quite differently from our own, with non-trivial regulatory implications, I think. So that's one. Joe Marie, on off-balance sheet assets or items, I think the question is probably, you can phrase the question, should anything be allowed to be off-balance sheet? And that's one way to ask it. Another way to ask it is, should how do you require a bank to take account of the risks which it has assumed? Now, why do I phrase it that way? Well, here's the simple reason. The Basel I purported to capture off-balance sheet assets. That was indeed regarded as one of its major accomplishments. This two-stage process of converting each balance sheet asset to an asset equivalent, which was then risk-weighted just as the balance sheet was risk-weighted, was rightly regarded at the time as a major advance in an effort to deal with the very different kinds of a mix of operations and functions that the big banks had. Among the many things we've learned in the last couple of years was that Basel I did not sufficiently capture all the credit risks to which the bank was exposed. Sometimes the reason for that was that the regulatory arbitrage efforts of a bank succeeded, so that something which was off, but even sometimes on balance sheet, was fitting into a Basel I category that it probably shouldn't have belonged in. But here's a more salient point, I think, as we try to figure out what the right question to ask is. You remember, I'm sure you do remember, the structured investment vehicles, the famous SIVs, okay? Now, some of these things, with some of these SIVs, which had been created by banks, had a continuing contractual or legal relationship with the bank, so that the bank was required to provide the liquidity enhancement or backup or to cover some losses or something of the sort. Whether you call that an off-balance sheet asset or an on-balance, it's hard to think of it as an asset, right? Whatever you call it, you really need to take account of it because it is a risk and a credit risk for the bank. Okay. Second, and this is the thing that is really worth taking note of, one of our major banking institutions had created at least one big SIV. I just love, one big SIV, with which it had no contractual, at least no credit enhancement type contractual obligations, no continuing ownership interest. The only thing was they had a contract to sort of help service things. Notwithstanding that, when the SIV got in serious trouble, the bank, the financial institution, took the SIV back onto its balance sheet and helped make good for, I don't know in the end how many of the losses and whether it was all of them, but certainly a lot of them. Now, why did the bank do that? Well, the bank gave only a sort of brief explanation, but my inference was that the bank was basically saying to itself, we can't have something that we created and marketed fail. Because if that happens, then everything that we've created and marketed becomes tainted in the eyes of other financial counterparties, other financial market actors, and the reputational harm to our bank will be substantial. Now, if that was the rationale, then we're going to have to say to ourselves that there was a credit exposure there, which did not show up on balance sheet, and it didn't show up off balance sheet either. So that's why I put it that way. It's a very complicated question, but it's the right. You're asking the right question. I think the only issue is how should we phrase it in order to capture everything we need to capture. It is, by the way, surely the case that there should be more stuff on balance sheet that is currently off balance sheet. How much more? That's the issue. Okay, and then circling back to Bill's question, I would say, Bill, two things that we've learned. Okay, first, that when it comes to supervising large internationally active institutions, big banks, big financial firms of any sort, but certainly big banks, the very breadth and complexity of their operations makes the supervision of that institution a real challenge and almost impossible effectively to achieve in the absence of some measure of international cooperation. You may recall the famous BCCI example from the early 90s. One of the wonderful things BCCI used to do is when it was time for the bank examination in, I don't know, the UK, they would look at their balance sheet and say, ooh, look at those assets. All right, let's get them to one of our affiliates in another country. And so what came on their balance sheet would be a obligation, credit extended to one of their affiliates. So it was within the bank holding company's own operations, interbank lending. All right? So the UK, at that time, the Bank of England examiners come in and they say, oh, you got this exposure? Well, it's one of your corporate, it's one of your bank affiliates. Good. So this looks pretty good. See you later. Okay? And the next day, they brought it all back onto their balance sheet. Meanwhile, the next subsidiary in another country is getting its examination and the same process. That's just a nice example. It's a graphic example of a more widespread phenomenon of trying to get a hold of exactly what the risk profile of the institution is and its assets. And for that, I think it's inevitable a certain degree of cooperation is necessary. I got one more point for Bill, and then I'll end. And the one more point gets back to a great paper by Larry White from NYU in, I think, 1994, around there, in which he said basically the following. Look, if there were a great single model of bank regulation, you wouldn't need an international agreement to get people to adopt it if it were really the best form of bank regulation. They'd do it unilaterally. Okay? The reason why you need some measure of cooperation is because there are always going to be pressures upon bank regulators, whether from banks, from legislators, maybe internally generated because they want to get a job, whatever the reason. There are going to be pressures to have a somewhat lax approach to fundamental safety and soundness regulation. It is not an unrestrained pressure because there are other incentives that they face as well. But, said Larry in that paper, that provides basically a rationale for something like Basel I, where in effect the regulators are getting together and saying, we all agree to do this, and this gets to my point about monitoring, we all agree to watch one another in order that we, almost like Ulysses tying himself to the mast, in order that we will not be in a position to tempt ourselves or to be pressured to have a suboptimal level of basic safety and soundness regulation. And I think in retrospect, Larry's rationale for an international agreement holds up a lot better than, if I can put it this way, some of the enthusiasts who tend to write in law reviews about, just the great things about trying to harmonize all of this stuff. Okay.
Dan, thank you for an enormous tour de force.
Thanks.
That was superb. This will be a huge component, I think, of policy consideration going forward, both here and around the world. We thank you for it, and we look forward to further iterations of applying your wisdom on all this topic. Thank you very, very much. Meeting adjourned.